Imagine stepping behind the velvet rope of a major digital platform, not just to admire its glossy facade, but to, truly understand its operational heart.
Hmm.
We're talking about the hidden risks it navigates, the fascinating ways it makes money, and maybe even the intricate deals that keep its top leadership in place. That's really our mission today.
Exactly.
We're diving deep into the recent quarterly reports and associated documents of a prominent digital company. We'll be dissecting its financial health, key operational metrics, the complex maze of legal and regulatory challenges, and the unique world of executive compensation.
And these official filings, the employment contracts,
Yeah.
think of them less as dry paperwork and more like X-ray vision.
X-ray vision, I like that.
They really show us how a massive digital entity actually functions day to day,
Hmm.
reveals what drives it, what keeps its leaders up at night. These aren't just numbers, they're blueprints.
Okay, so let's unpack this. When we talk about a digital platform's health, it's easy to focus on flashy revenue figures, right?
Right, the top line.
But these reports give us a way to peek into its operational pulse. What are the essential vital signs we really need to check here? And why are they so crucial?
Well, to really understand this company's pulse, we need to look beyond just revenue at three core operating metrics they use internally.
Okay.
First, there are daily active users, or DAUs. Now, for this platform, a DAU is simply someone logged in and visiting via their website or app on a given day.
Seems straightforward enough.
But here's the crucial nuance, the thing many overlook. DAUs are not a measure of unique individuals.
Ah, okay. So one person could be multiple DAUs.
Exactly. One person can have multiple accounts. And the company even acknowledges, the potential risk of fraudulent accounts or bots inflating these numbers.
So it's really about account activity, not necessarily unique people hitting the platform. That's a really important distinction to keep in mind. What's next?
The next up is hours engaged. This basically captures the total time users spend on the platform.
How sticky it is.
Precisely. It aggregates session lengths. They track these sessions across various devices, mobile, web, game consoles, and their methodology, and it can evolve over time as they try to get more accurate.
Makes sense. And finally, the lifeblood, right? The money. How does it actually generate cash?
Yeah, that brings us to bookings. This is a really key metric for them, a non-GAAP financial measure,
Non-GAAP, okay. Meaning,
meaning it's not strictly by standard accounting rules, but for this company, it gives us a more immediate sense of how much cash is flowing in. It sort of bypasses the complex revenue recognition rules we'll probably talk about.
got it. So where do bookings come from?
Primarily from sales of their virtual currency, Robux,
Robux, right?
which people buy via, one-time payments, subscriptions, or prepaid cards. There are also smaller amounts from advertising and licensing, but Robux is the big one.
Okay, here's where it gets really interesting for me. How did these different metrics, DAUs, hours engaged, bookings, how do they interrelate? What story did they tell us together about, like, user behavior and platform growth?
Well, the company states these metrics are highly correlated. And over the long term, they expect hours engaged to grow slightly faster than DAUs.
So people who use it more over time.
Exactly. And then, bookings are expected to grow faster than hours engaged.
Ah, so engagement leads to spending.
That's the idea. It
Right.
tells this potentially powerful story. As they improve content, users stay longer, more users eventually become payers, and those existing payers tend to increase their Robux purchases over time. It's the virtuous cycle they're banking on.
Let's talk more about that money side. We hear revenue all the time, but you mentioned these sources emphasize bookings. What's the key distinction again, and why is bookings considered timelier?
Right. The key difference is how revenue is recognized, counted officially. This company recognizes revenue from sales of durable virtual items over the estimated average lifetime of a paying user.
Okay, how long is that?
Well, as of Q2 2025, they estimate it to be 27 months. And interestingly, they even had a recent accounting change back in Q2 2024 that decreased this estimate by just 1 month, from 28 to 27.
Doesn't sound like much. 1 month.
You'd think so. But that small change actually resulted in an increase of nearly $59 million in reported revenue for that quarter alone. It shows how sensitive revenue figures can be to these estimates.
Wow.
Bookings, on the other hand, give you a much timelier view because they reflect when the actual transactions happen, when the cash comes in. It avoids that delay from deferred revenue recognition.
Okay, that makes sense. Looking at the numbers then, total revenue hit just over $1 billion in Q2 2025. That's a solid 21% increase from the previous year.
Pretty good growth.
And total bookings, that timelier indicator you mentioned, hit almost $1.5 billion in Q2 2025. It's notable that this increase in bookings was primarily driven by a big jump in daily unique paying users.
Yeah, that number grew significantly, from nearly a million to close to 1.5 million year over year.
So more people opening their wallets.
Definitely. But what's truly fascinating, I think, is when we look at average bookings per DAU or ABPDAU, how much they make per active user.
Okay, what does that show?
It reveals these stark differences in monetization potential across different parts of the world.
Hmm.
The global ABPDAU in Q2 2025 was around $13.
Right.
But then you look at the US and Canada, it was dramatically higher there, over $40 per user.
Wow, big difference.
Huge. Europe's was around $11, but Asia Pacific and the rest of the world, much lower,
Yeah,
under $5 per user.
under $5.
Yeah. And this reveals a really critical strategic challenge for them. Even though regions outside of the US and Canada account for a massive 82% of their daily active users,
82%.
they only contributed 38% of the revenue.
So most of the users are bringing in a relatively small slice of the pie.
Exactly. It points to this clear hurdle in converting that broad international user adoption into proportional revenue.
So if they're seeing such a low return on, the vast majority of their users internationally, what's the strategic play there? Are they just banking on future monetization as those economies grow, or is this something structural they need to tackle head on, maybe different pricing, different content?
That is the multi-billion-dollar question, isn't it?
Yeah.
The data suggests it's likely a mix. They're investing heavily in content globally, but they're also navigating really diverse economic conditions and different consumer spending habits.
Right.
So for an investor or just anyone watching, the question becomes, how quickly can they close that monetization gap? Or will growth in these lower ABPDU regions just keep diluting their overall profitability metrics?
It's a balancing act.
It really is. But despite that challenge, it's worth noting, the company has seen a very positive trend in the total number of unique payers overall. That grew from about 13.5 million 2 years ago to 23.4 million in the latest quarter. So more people are paying, even if the average amount varies wildly by region.
Okay, so we've seen how they're bringing in money, growing users, growing payers, but what does this all actually mean for the bottom line? These sources consistently point to, well, a history of net losses and expectations for increasing operating expenses.
That's absolutely right. This company has actually incurred net losses every year since its inception. In Q2 2025 alone, they reported a consolidated net loss of nearly $280 million.
$280 million loss in one quarter.
Yep. And their accumulated deficit, the total losses piled up over time, was almost $4.5 billion as of June 30, 2025.
$4.5 billion, that's significant.
It is. And they fully expect operating expenses to keep increasing. They're driven by big investments in infrastructure, stock-based compensation for employees, and also the really substantial legal, accounting, and compliance costs that just come with being a large public company.
Okay, that kind of accumulated deficit signals. Well, it raises questions about the path to profitability, doesn't it? How long can they keep investing like this without turning a corner? Let's break down where money is actually going. The report outlines several key expense categories, right? And what's driving their growth.
Exactly. When we look at their spending from Q2 2024 to Q2 2025, a few areas really jump out. Their cost of revenue went up by almost 20%. That's largely tied to higher payment processing fees, which, makes sense with bookings going up.
More transactions, more fees.
Okay, then there's a massive surge, 46% for the first half of the year, in developer exchange fees.
What does that mean exactly?
That's basically the cut paid out to the creators who build experiences on the platform. It tells us how much more money those developers and creators are now earning. It's partly driven by just more engagement, but also by the launch of differential Robux pricing back in November 2024.
Interesting. So creators are making significantly more. What else?
Infrastructure and trust and safety costs rose by 18%. Mostly data centers, technical infrastructure, personnel costs, keeping the lights on and the platform safe.
But wasn't there something about efficiency gains there?
Yes, good point. There was actually an offsetting factor, a $6.2 million decrease in moderation and customer support costs within that category. They attribute that to internal efficiency gains and, importantly, automation from AI-driven tools.
Ah, so AI is making a tangible difference in the bottom line there. Always interesting to see. What about their innovation engine?
R&D.
Research and development expenses were up 6%. Again, primarily personnel costs, hiring more engineers, designers, product folks. The company explicitly plans to keep increasing these expenses to develop new features and drive innovation.
And admin costs,
Oh.
general and administrative.
Those saw a significant 44% increase. Again, personnel, including stock-based compensation, is a big part. But notably, there was a $10 million jump specifically in professional services related to litigation costs.
Oof, legal bills stacking up.
Seems like it. Finally, sales and marketing increased by almost 50%, reflecting growth in personnel there too. Plus more spending on advertising and promotions as they continue investing to drive business growth. Okay, so as we look at all these costs rising, developer fees, infrastructure, R&D, admin, marketing, I'm trying to connect the dots. How exactly do these big expenditures align with the company's longer-term vision? It raises that important question again. How do they plan to bridge this gap between spending so much now and eventually turning a profit?
Well, they aim for what they call operating leverage, generally looking towards the end of fiscal year 2025.
Operating leverage, what does that mean in plain terms?
It basically means that over time, their revenue should ideally grow faster than their costs. So each new dollar of revenue becomes more profitable than the last. It reflects this strategy of really aggressive investment now.
Laying the foundation.
Exactly. Laying the foundation, anticipating that these big upfront outlays in tech, R&D, marketing will ultimately lead to a more efficient and profitable operation down the road, even if it means racking up those losses and that big deficit in the short term.
But given that history of losses and this very aggressive spending, how risky is that operating leverage strategy? I mean, what are the key milestones or indicators we or, investors should look for to see if these investments are actually paying off rather than just, well, burning cash?
It's definitely a high-stakes bet, no question. For anyone watching, it's crucial to monitor their growth rate in bookings very closely relative to the growth in expenses, particularly those big ones like R&D and sales and marketing.
See if revenue is outpacing costs.
Precisely. And that average bookings per DAU metric, especially outside North America, will be absolutely key. Are they starting to monetize those massive international user bases more effectively? If costs keep climbing faster than they can improve that diversified global monetization, well, then the operating leverage won't materialize, and those losses could become unsustainable.
It's definitely clear that operating a global digital platform like this comes with immense complexities. The sources are very upfront about a whole host of risks, everything from escalating legal battles to a rapidly shifting regulatory landscape. Let's try and dig into those.
Yeah, absolutely. And before we even jump into specifics, it's really crucial to remember the company's own special note regarding forward-looking statements that you find in these reports.
The boilerplate stuff.
Kind of, but it's important here. They explicitly state their future outlooks are not guarantees. They're subject to substantial risks and uncertainties, and crucially, the company says it has no obligation to update these forward-looking statements.
So basically, anything could happen, and don't blame us if our predictions are wrong.
Pretty much. It really sets the stage for the significant challenges they acknowledge they face.
And some of those challenges are definitely legal. The documents mention the company is grappling with multiple class action lawsuits. One set alleges minors used third-party virtual casinos to gamble Robux away.
That's right. Colvin v. Roblox and Gentry v. Roblox. The claims moving forward include things like negligence, violations of California's unfair competition law, unjust enrichment, companies fighting back, even filing cross-claims against the virtual casino defendants for IP infringement. There's a hearing on a motion to dismiss parts of it set for early September 2025.
Okay, so that's ongoing, and there was another one, copyright.
Yeah, Robinson v. Bonello. An allegation that a song was used without permission in a popular experience called Meat City. Claims for direct and vicarious copyright infringement are proceeding there too. So yeah, significant legal battles on multiple fronts.
And that's just the specific lawsuits. You mentioned a broader regulatory landscape.
Exactly. Beyond specific lawsuits, there's this rapidly evolving global regulatory environment that poses considerable risks. You've got international laws like the UK's Online Safety Act, the EU's Digital Services Act.
We hear a lot about those.
And they're introducing really stringent new duties for platforms, especially around child protection, conducting risk assessments, content removal systems. And the penalties for non-compliance are substantial. We're talking potentially up to 10% of global revenues for the UK Act, up to 6% for the EU DSA.
Huge potential fines.
Massive. Plus, we saw a recent ruling in Brazil partially dooming part of their Internet Act unconstitutional, creating new platform liability for third-party content there.
So the rules are changing everywhere, sometimes in conflicting ways.
That's the challenge. Compliance with these evolving, sometimes conflicting laws increases costs significantly. It might require them to actually modify content or features on the platform, or even in some cases, restrict access entirely in certain countries. Like what happened in Turkey last year when the platform was blocked for a time.
Wow. Okay, so beyond legal and regulatory pressures, what about just the fundamental operational challenges, things that can directly hit the user experience and the company's stability?
Absolutely critical. Users, as you know, expect fast, reliable systems. So platform outages and security are paramount.
Right, nobody likes it when the site is down.
Exactly.
Yeah.
And they've had past outages like in June 2025 and a big one back in October 2024. These things can really harm their reputation, obviously reduce user engagement, and negatively impact financial results.
Yeah.
Plus, they incur significant ongoing costs just trying to detect and prevent security breaches.
And fraud. Is that still an issue?
Oh, yes. It's a persistent challenge. Unauthorized sales and purchases of Robux and accounts happen, both on and off the platform, sometimes involving fraudulent credit card use. They mentioned that chargebacks and refunds were about 2.7% of bookings in Q2 2025.
2.7% doesn't sound enormous, but on 1.5 billion in bookings.
It adds up quickly. It's a continuous drain on revenue and increases their costs. So even as they pull in billions, there's this constant sort of leakage of revenue from these shadowy, fraudulent activities. It's a cost many people might not even factor in.
And what about their reliance on other big tech companies?
That's another huge one. There's significant dependence on the major mobile app stores, Apple App Store and Google Play Store, is a material risk.
How significant?
Well, Apple's App Store accounted for 29% of their revenue in Q2 2025. Google Play was another 15%.
Almost half the revenue comes through those two stores.
Pretty much.
Yeah.
And those platforms, as we know, can charge hefty commissions, up to 30% of proceeds, which is a major operating expense. And crucially, Apple and Google can change their terms, their fee structures, basically whenever they want. That poses a constant material risk.
A lot of external dependencies. And having a global footprint means facing global economic and geopolitical headwinds too, right?
Precisely. We talked about the monetization gap. 82% of users outside US and Canada bring in only 38% of revenue. This exposes them to the risk that expanding further into developing countries, regions with potentially weaker consumer spending, could actually slow down their overall bookings growth and drag down that average bookings per DAU metric even more.
Makes sense. What about geopolitics? China?
Yeah, that's definitely on their radar. U.S.-China tensions and trade restrictions could harm their ability to operate in Chinese markets, potentially impacting their joint venture there.
Do we know specifics?
Well, they mentioned that Tencent Holdings, which is an affiliate of their joint venture partner in China, was added to a U.S. Department of Defense list back in January 2025. And there are ongoing inquiries from CFI-US, the Committee on Foreign Investment in the U.S., regarding Tencent's investment in the company itself. So regulatory scrutiny is definitely there.
And just the broader economy, inflation.
Yep. Macroeconomic conditions loom large. Historically high inflation rates, particularly in the U.S. and Europe, could affect pretty much all their expenses, from infrastructure to personnel. And, maybe more importantly, it could reduce consumer discretionary spending, people having less money for things like Robux, impacting demand for the platform.
This all raises a really important question. How does the company's internal structure, its corporate governance, address all these multifaceted risks, especially thinking about control and long-term stability?
This is where things get quite interesting, structurally. The company has a dual-class stock structure. Meaning the founder, who is also president, CEO, and chair of the board, holds a special class of stock, Class B common stock, that gets 20 votes per share compared to just 1 vote for the regular Class A shares the public holds.
20 votes per share.
20. This effectively concentrates voting control entirely in his hands. It limits the influence of all other stockholders over critical corporate matters like electing directors, approving mergers, things like that.
So public shareholders have very little say.
Essentially, yes. While it provides stability and allows the founder to execute a long-term vision without worrying about shareholder pressure, it also significantly reduces accountability to broader market interests.
And they changed where the company is incorporated.
They did. They reincorporated from Delaware to Nevada back in May 2025. And Nevada law, combined with the company's own articles of incorporation and bylaws, includes various anti-takeover provisions.
Like what?
Things like a classified board, meaning directors serve staggered terms, making it harder to replace the whole board at once. Restrictions on stockholder actions, for example. Once the Class B shares eventually convert, stockholders might need to call a meeting rather than just act by written consent. Plus, requirements for a supermajority vote, like 66 and 2/3%, to approve certain amendments, all designed to fortify internal control.
Making it harder for outsiders to gain influence or force changes.
Exactly. It's also notable that their bylaws designate a specific court in Nevada, Clark County, as the exclusive forum for many internal corporate disputes. And their articles of incorporation even include a waiver of the right to a jury trial for those kinds of internal actions.
They can just waive your right to a jury trial. Is that enforceable?
Well, they note that the enforceability of that specific jury trial waiver hasn't actually been tested or adjudicated yet, so it's
Wow.
in there. But whether it would hold up in court is an open question.
Interesting. And dividends, are they paying shareholders anything?
No. The company states clearly they do not expect to pay dividends or make other distributions in the foreseeable future, meaning stockholders have to rely entirely on the stock price going up for any potential gains.
Okay, let's pivot now to a really fascinating look at the human capital side of this company's financial structure, specifically how they incentivize and, maybe more importantly, protect their top leadership. These documents offer a pretty unique glimpse into the sometimes complex world of executive compensation.
Yeah, they really do. We can see this very vividly if we look at the example of Naveen Chopra's employment offer and his separate change in control severance agreement. He's a top executive there.
Okay, what does his package look like?
Well, his annual base salary is substantial, around $735,000. But that's just the base. His total target compensation is way higher, over $13 million a year.
13 million. How does that break down?
It's heavily weighted towards equity, primarily in the form of restricted stock units, or RSUs, and performance stock units, or PSUs. His target for those is over $12.5 million combined per year.
So mostly stock-based pay. What are RSUs and PSUs again?
Right. RSUs are essentially company shares that are granted but vest, meaning become fully owned, over a set period of time. PSUs are similar, but their vesting is often tied to the company or the executive achieving specific performance targets. So, big incentives tied to future performance and stock price.
And I recall reading he also received some massive new hire incentives just for joining.
He certainly did. A very substantial RSU new hire grant worth $28 million at the time of grant.
28 million just to sign on.
Yep. Plus two separate cash signing bonuses totaling $6 million. One $3 million bonus that vests over 3 years, and another $3 million paid as a lump sum right away with his first paycheck.
Wow. Anything else in the offer? Perks?
Well, there's a requirement for him to relocate to the San Mateo HQ by August 2026. But they provide significant relocation assistance to help with that, up to $900,000, plus reimbursement for temporary housing.
900,000 for relocation. Okay.
And interestingly, the company even agreed to indemnify him, basically cover his legal costs for potential claims arising from prior non-competition agreements he might have had with his previous employer, Paramount Global, though they specifically excluded claims related to soliciting former colleagues or misusing confidential information.
That's quite specific. Okay, what about protections? Severance. If things go sideways or the company gets sold, do these documents shed light on how they keep key people like him stable, even through major shifts?
They absolutely do. His severance benefits, particularly upon what's called a qualifying change in control termination, are very comprehensive.
What does that term mean?
It essentially means if he's terminated without cause or if he resigns for good reason
Mm.
during a specific period around a change in control of the company, like a merger or acquisition.
Got it. So what happens then?
He gets 100% accelerated vesting of all his unvested equity awards, those RSUs and PSUs, and any performance goals tied to the PSUs are automatically deemed achieved at their target levels. So a potential huge payout triggered by that kind of termination event.
Full vesting. Okay. And what constitutes good reason for him to resign and still get that payout?
The agreement meticulously outlines those conditions. It includes things like a material reduction in his base salary, a significant adverse change in his title or duties, for example, if he were no longer the CFO of a public company, or if he stopped reporting directly to the CEO, or even if the company tried to relocate his primary work location more than 35 miles.
So pretty strong protections for him to ensure his role and compensation remain stable.
Very strong. It's designed to keep him focused on the job, even amidst uncertainty.
Now, if we try and connect this back to the bigger picture, given the company's dual-class stock structure and the founder's concentrated voting control, how did these executive incentives really align with the interests of other shareholders, especially if a change in control is, practically speaking, almost impossible without the founder's blessing?
That's a really critical point, isn't it? While these agreements are clearly designed to attract and retain top-tier executive talent, which is arguably good for all shareholders, and ensure leadership stability even when facing all those market and operational risks we talked about.
Right.
The dual-class structure does mean that other shareholders have very limited direct influence over major corporate direction or a potential sale of the company.
So the executives are well protected in a sales scenario, but a sale might be unlikely anyway.
Exactly. The generous changing control clauses protect executives if that rare event does occur. But for the majority of shareholders holding the Class A stock, their potential gains are primarily tied to long-term stock price appreciation, driven by the current leadership's decisions. The leadership, they have little power to change rather than a potential lucrative takeover premium or a direct say in governance.
It highlights that potential divergence of interests.
It certainly can. And we also saw examples in the documents of how these clauses actually play out in real-world executive transitions. They detailed the specific handling of Michael Guthrie's equity awards upon his departure, illustrating that these aren't just theoretical agreements on paper. They have real financial consequences during leadership changes. Hashtag outrag outro.
So after all that, what does this really mean for you listening? We've just completed a pretty deep dive into the multifaceted world of a major digital platform. We've moved beyond just the simple revenue figures to explore its intricate operational metrics, the escalating legal and regulatory pressures it faces daily, and the very structure of its corporate control and those detailed executive incentives.
Yeah, to quickly summarize the key insights. Understanding those non-GAAP metrics like bookings, it really provides more dynamic, maybe more real-time view of the financial activity than just looking at traditional revenue alone. We saw how monetization strategies reveal these really stark regional differences that clearly impact overall profitability. The whole digital landscape is increasingly fraught with legal liabilities and these evolving regulatory mandates, pushing companies like this to constantly adapt.
Constantly reacted.
Constantly. And finally, those robust executive agreements, they're clearly critical for attracting and retaining top leadership in such a complex, competitive environment. They offer both huge incentives and crucial protections that ultimately shape the company's direction and future.
So here's a final thought for you to maybe mull over. In an era where these digital platforms are so deeply integrated into our society and we're all facing constant information overload, how might a company's financial reports need to evolve? Could they or should they reflect not just monetary performance, but also adherence to ethical standards, data privacy, overall societal impact, especially concerning things like user safety and well-being?
That's a great question.
What metrics would you want to see if you were investing in a company like this, going beyond just the dollars and cents? Something to think about.